downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host, Andrew Tysers from our Global Markets Research team, and it's currently very late in the day on Friday, August 22. Well, we've held back production a little today because we wanted to capture Fed Chair Powell's long-awaited speech at the annual central bank gathering in Jackson Hole. He's just spoken as we record, so in a moment we're going to jump straight to David Seif from Nomura's New York-based research team to get his immediate take. We also have a special guest for you today, Jonathan Cohn, our head of US Rates Desk Strategy from our Global Markets business, will offer some market perspectives, though we certainly won't be making any investment recommendations or offering investment advice. Andres Stepaniak from our London office will also be on, discussing the ECB and European inflation trends, and we'll touch on the Russia-Ukraine war and implications. We'll be looking at that through a narrow economic lens. But let's not forget Asia. This week we'll take a look at key coming China and inflation data in Japan too. And Jong-Woo Park from our team in the region will give us his take on two more central bank meetings out next week in Korea and the Philippines. Plenty going on, so let's dive in. So, moving straight to the US, I'm delighted to be joined here by David Seif, Nomura's Chief Economist for Developed Markets. David, a busy day for you. Thanks for squeezing in some time with us.
Wonderful to be here, Andrew.
Excellent, thank you. Now, we've just heard from Fed Chair Powell. Markets were waiting for this one all week. What were the key messages for you?
Certainly was at least somewhat dovish speech. There were a number of elements that first of all, make it seem like this is somewhat of a Fed pivot. Powell is clearly signaling that at least in the not too distant future, cuts are going to resume. There were a number of things that he did. First of all, he explicitly stated that the balance of risk may be changing. And of course, that is more than anything else, the most dovish aspect of the speech. He also dug into the labor market data. And one thing that he did not do was try to dismiss the weak NFP numbers. He noted them and he said that they were a sign of potential weakness in the labor market. At the same time, I don't want to overstate how dovish the speech was. And it did leave the door open to many different possibilities. As we had expected, he did put a lot of emphasis on the unemployment rate, pointing out, A, that the unemployment rate was only 4.2%, which is a historically very low number, and B, explicitly stating that the quote-unquote break-even rate of NFP, or the number of jobs that need to be created each month in order to keep the unemployment rate steady, has declined. So it's not to say that 35K average for NFP over the past 3 months is anything other than soft, but it's not as soft as it would have been if the break-even rate were significantly higher still than it now is. Going back to the dovish side, he did address the slowdown in GDP. We've only been growing and expect to grow at Nomura this year for the U.S. only at 1.0% on a Q4 over Q4 basis. And Powell clearly acknowledged that this is happening. At the same time, there were some hawkish elements in there, and I don't want to overstate them, but to point out that this was not a one-way dovish speech. Powell did mention that that services inflation is a little bit higher than would be consistent with 2% inflation. And that was a bit of an upgrade on the hawkish side, I mean, compared to his statements after the July FOMC meeting. And it's consistent with what was a decently hot inflation report that we got earlier this month in things that are not related to the tariffs. But all in, definitely dovish. He pointed out that also that as he put it, a reasonable base case for tariff-induced inflation is that the Fed does not need to respond too much to it because it is a one-time hit. And I think all of these things together, certainly a more dovish speech than not.
Okay, excellent. Thank you. So, yeah, certainly on the dovish side, but maybe not super dovish, as you note there. How does that leave you feeling about the upcoming policy meeting on 17 September?
Yeah, we changed our view after the CPI report earlier this month to expect a September cut. So we still expect three cuts from the Powell Fed in his the remainder of his tenure. We had previously thought that they would not start until December. Now we think they'll start in September, and at a quarterly cadence. So September, December, and March. I think that when we look at September, there really are three reasonable options available. Reasonable because there's still a lot of data between now and that September meeting. We do think that the base case certainly is a 25 basis point cut. I think that the next most likely outcome, and also a very reasonable outcome or plausible outcome, is that the Fed does not cut at all. If we have a very strong labor market report on September 5th, and or clear signs of tariff-induced inflation in the September 11th CPI report, that may cause the Fed to want to hold. And I don't think anything Powell said prevents the Fed from doing that if the data develop that way. Similarly, I think it's very plausible, the third most likely outcome, but still plausible, that we get a 50 basis point cut in September. And that would happen if we were to get another very soft employment report on Friday, September 5th. I think if we were to get a very weak 4.4 or a 4.5 in the unemployment rate, which is not what we expect, but you never know, that would probably be consistent with a 50 basis point cut.
Okay, so you mentioned some of the key data there to look out for as we head to 17 September. Looking at the calendar, we do get an important inflation reading, core PCE deflator next week. I guess that will obviously be an input. What's the team thinking about that one?
We're expecting a 0.287% core PCE. That is a little bit lower than the core CPI that we got, and a lot of that is due to the fact that part of what drove CPI inflation so high was airfares. But the airfares component that go into CPI actually does not go into PCE. PCE gets it from the airfares component from PPI, and there it was much more muted. So this leads it to be, we think, a little bit softer. Still, it's going to, we think, round up to 0.3. That's a little bit hotter than the Fed would like, but there's nothing in here that we expect to show strong signs of tariff-induced inflation, since we didn't get that in the CPI to begin with.
Okay, that's perfect, David. Thanks so much.
My pleasure. Great to be here again, Andrew.
Federal Reserve Governor Lisa Cook says she will not be bullied into stepping down from the central bank. This after President Trump called for her resignation over allegations of mortgage fraud.
Now to our special guest, John Cohn, Nomura's head of US rates desk strategy. John sits in our New York dealing room within our global markets business, so he's not part of our research team. And I should stress what you're going to hear here is not investment advice or investment recommendations, but I think John can bring a fresh perspective on markets. So, hey, John, that's a long introduction, but thank you for coming on the show.
Yeah, thanks, Andrew. Happy to be here.
Excellent. Thank you so much. Now, look, I thought we'd start by looking at the Fed from a different perspective. I've just been speaking with David Seif about his thoughts on the communication from Powell. But I wanted to tackle the Fed from a different angle. We've seen unusually sharp criticism from the Fed, of the Fed by President Trump, including a demand that Fed Governor Lisa Cook should resign. I played a little snippet there from Tom McKenzie from Bloomberg News touching on that. So, look, I thought I'd start by asking, how serious is this threat to Fed independence?
Yeah, it's serious. We absolutely need to take this seriously. Appointing policymakers more inclined to do the bidding of the White House than to deliver on the dual mandate could sacrifice central bank credibility generally and hard-won anchoring of inflation expectations more specifically. Trump clearly wants lower rates and will want to appoint a chair who agrees. The chair can't unilaterally adjust monetary policy, of course, but Trump will have more influence than just that, and as you noted, is not shy about pushing for even more. Assuming the Senate affords him the same support seen in prior appointments, Trump will have his choice to replace Powell as chair and likely governor, install someone for Kugler's vacated spot, and potentially Cook's spot if she's forced to resign or fired. Add these to the existing governors Waller and Bowman, who have already seemed quite sympathetic, and you get a pretty sizable voting bloc there on the FOMC. And while not necessarily enough to force policy to the extremes in the near term, given there are, after all, 12 FOMC voters on the committee, policy may still be biased easier in the medium to longer term, not just the shorter term. And that could obviously be a problem to credibility, which is really critical. There's also the risk for other sorts of regime change, for instance, some kind of updated Treasury Fed Accord, more coordination between those two institutions, or even a politicized board of governors that could exert discretion over regional bank president appointments. Those need approval every 5 years. So, I'm not saying this is where we're heading, but these risks can't be wholly disregarded, especially with so much talk of regime change. As ever, perception is often reality for the markets.
Understood, yeah. So look, this does sound serious, doesn't it? And in terms of financial markets themselves, what could be some of the implications there?
Yeah, generally I would expect risks tilted towards a steeper yield curve, higher inflation break-evens. A politicized Fed intent on delivering cuts would drive front-end yields lower, of course, but the back end would likely embed more upside inflation risk and risk premia. We saw that, for instance, after the Fed surprise 50 basis point cut last September, which in retrospect was seen as more of a policy mistake. Anchored inflation expectations depend on the presumption that the Fed will succeed in its price stability mandate over the long run, or at least will try to succeed in good faith, not just let inflation run hot. If that presumption is challenged because the Fed is politicized, so too will be the market's ability to self-regulate financial conditions, to self-regulate rate expectations in service of target inflation. And that's critical. Without that regulation, inflation expectations, inflation risk premia, even real term premia could increase, and you could see more frequent twisting of the yield curve, bond hedging value become even more challenged. And I think, as I mentioned before, the Treasury Fed coordination, any hint towards that would be perceived as, I think, inching towards fiscal dominance or potentially even some yield curve control. And such a policy shift would likely come at the expense of the dollar and inflation stability. That is, pressure would get squeezed from higher nominal rates into a weaker dollar, into higher inflation.
Okay, look, and with all these thoughts, I guess there's been a lot of discussion, really from investors globally, around all these risks and the perception that global investors might shy away from US bonds. The de-dollarization theme has been capturing attention, of course. How does all of that sort of fit into your broader view on Treasury demand?
Sure. Yeah. The Sell America or the de-dollarization theme, I think, really came to the forefront in April, but it's since receded back into the background. And I think for good reason. I've long thought the threat of a sharp pullback in U.S. sponsorship was a bit overblown. Portfolios underhedged to the dollar amid the run in U.S. exceptionalism have had to come to terms with different hedging ratios. But from what I see, overall dollar asset sponsorship remains pretty robust. De-dollarization almost has to be a slow burn theme. It's like an instant transition away from fossil fuels, right? A sharp move away from the dollar is basically impossible, whether as a means of exchange, a source of trading liquidity, a store of value. There's really nothing that comes close. And diversification of FX reserve portfolios, which has been going on for decades, can continue, but that doesn't concern me so much. We've seen that happen, and the market has been fine throughout that process. Admittedly, though, what I am a little bit more concerned about in the medium term is the safe haven status of Treasury debt, especially with Fed credibility, like we talked about, and political stability undergoing some reevaluation, let's say. So that'll be something to monitor. But generally, foreign demand for treasuries has remained solid despite all of this. While a lot has been made of the pullback in sponsorship from China, let's say, custodial transfers to Euro area financial centers like Belgium and Luxembourg seem to explain much of it. And demand for treasuries in other jurisdictions like UK, Europe, some tax advantaged countries, that's remained robust as well. On the foreign official side, accounts may have shortened their maturity profile, migrated into maybe, let's say, more liquid products, T-bills, repo, but they're not migrating away from the dollar. They're migrating into more liquid expressions of the dollar. So all in all, demand for dollar assets hasn't dried up, We've seen some big foreign buyers plow on, others have redistributed. But I think, to wrap it all up, overblown de-dollarization concerns, Treasury's strategy to reduce the duration burden on private investors by leaning net issuance into bills, and the Fed easing bias all supports duration, and I think particularly in the belly of the curve.
Okay, understood. Look, there's so much going on here, and it's such an important theme for markets. Hey, John, I really appreciate you taking the time to come on and share some of your thoughts here.
Anytime, Andrew.
Now, moving to Europe, I'm very pleased to be joined by Andres Stepaniak from Nomura's research team in London. Hey, Andre, looking at the calendar for Europe next week, I see we have some ECB speakers, Villeroy and Guindos, coming out. They're pretty big names. What are you thinking about the ECB at the moment?
Hey, Andrew, thanks for having me on. Look, as you say, those are pretty big names. The ECB speak, at the moment at least, has been pretty similar to what we've seen in the June and July meetings, essentially underscoring a sort of wait-and-see mode. They essentially want to see how the data pans out over the coming months and quarters, and they really want to see how US tariffs actually impact the real economy. And obviously, bearing in mind, we've had that US-European trade deal, the sort of tariff rate above the initial 10% came into force in August, and really we shouldn't be expecting any ECB speak to deviate too much from what we saw in July, and sort of wanting to wait and see how those tariffs, or the rise in the tariffs versus the 10%, will actually impact the real economy.
Okay, understood. Now, there's also a fair bit of inflation data coming out across the region there too. Tell me something about inflation in Europe.
Look, so in terms of inflation, we're forecasting actually it to sort of hover around the ECB's 2% target until year end. In terms of the actual upcoming prints, the focus there will be twofold. Firstly, will services disinflation, or sort of momentum in services prices, will that continue to ease gradually as we forecast? And secondly, what's going to happen to core goods prices? So there are two factors here. The idea being US tariffs could potentially raise core goods prices if, for example, you have issues to do with, say, supply chains and so forth. We don't think it'll occur just yet. The second point is, do you see any Chinese goods dumping, which then feeds into much weaker than expected core goods prices? Again, that wasn't the case in July, and we're not forecasting it to be the case yet in August, but those are the two things to watch out for.
Okay, understood. And finally, Andre, a difficult topic, but an important one. This week we've been following the Russia-Ukraine war and associated meetings involving Trump. If we limit this and just look at it through an economic lens at the moment, does the outcome here have capacity to shift the economic outlook for Europe?
I think it could. If you have a scenario where actually you have the resolution of the war, the first question is what happens in terms of reconstructing and rebuilding Ukraine? And we do think that if that does occur, you're going to have further joint EU issuance to help support that effort. And that can be a material fiscal impact, firstly. The second question then is which firms actually go in to rebuild Ukraine? Is it a case of European firms are going in, which actually will be a sort of boon for Euro area economic activity, or is it US firms going in to rebuild at the expense or the cost of Europeans?
Nothing like a crisis, I guess, to bring people together. Andre, thanks so much for covering all of that.
Thanks, Andrew.
Okay, moving to Asia now. We have Jong-Woo Park from our AEJ research team based in Singapore here with us. Hey, Jong-Woo, thanks for coming back on the show.
Thanks for having me.
Excellent, thank you. Look, central banks, of course, remain a big focus for us, and I know you watch Korea closely, and Bank of Korea are coming out next week. What are you expecting?
I expect the BOK to deliver neutral or a dovish rate hold because recently, after the government tightened credit policy with the introduction of lending cap, there is sign of the the housing prices and household debt cooling down. So I think the BOK now is shifting its focus back to growth. So even if we see the tariff deal, but I think the BOK is likely to highlight there is still uncertainty around the growth outlook because the tariff impact may appear later this year. So the BOK is going to leave the door to rates cut open. So if we see the BOK forward guidance remaining largely unchanged or turning slightly more dovish, then I think that could be very strong indication of further rates cut in Q4.
Okay, so that's interesting. I guess we're getting fewer tariff announcements, but we're left to study the implications and to see how that comes through in the data. Now, we also have another central bank in the region. In the Philippines, BSP are out next week too. Could we see a rate cut there?
Yeah, we also expect BSP to cut pulse rate by another 25 basis point. Because of the weak inflation outlook, despite the improvement in Q2 GDP growth, there is still concern around the lower than expected CPI inflation printing. So we believe the BSP will remain relatively dovish.
Okay, so that is interesting. BOK potentially a bit dovish and a rate cut in the Philippines. Look, I could add here that this week we saw a surprise rate cut in Indonesia as well, and a rate cut in New Zealand, which was expected, but one which came with very dovish communication. So it does look like we are seeing, across the region, weaker activity in China, an absence of inflation pressures, and more rate cuts starting to come through. Hi, Jong-Woo, thanks again for coming on and helping us cover some of these developments.
Thank you.
Now, elsewhere across the Asia region, we'll finish with two quick highlights. First up, China. PMI data will come out next weekend, 31 August. We expect the official manufacturing PMI to remain muted at 49.3. That's unchanged from July and held back by a couple of things: slowing export momentum, the ongoing anti-involution campaign to rein in excessive competition, and some payback from earlier strength relating to the consumer trade-in program. Our China team also expect the official non-manufacturing PMI to ease a fraction to 50.0 in August from 50.1 previously, noting impacts from the austerity rule and falling seasonal summer holiday demand, although a booming local stock market there could provide some support. This theme in China of a deceleration in growth momentum but a giddy stock market could be one to watch too. And finally, Japan. We expect Tokyo CPI to ease to 2.5% year over year in August from 2.9% previously. And with the ex-fresh food and energy measure, that's the BOJ's so-called core measure, easing 0.1% to 2.9%. And we think industrial production in Japan could have decelerated in July by about 1.5% in the month, with some hit from US tariffs. Okay, so there you have it, our views on major market themes and what to look out for next week. This podcast has been written by Andrew Ticehurst and the Global Markets Research team and expertly edited and produced by John Dalton, as always. Thank you for listening in. If you did enjoy the podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud, or wherever you go for your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log into nomuraconnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Numura Connects at www.numuraconnects.com.